History did not break new grounds in 2008. It just replayed itself, louder than ever, as if the eerily similar panic of 1907 never happened. The 2008-9 global financial crisis was a three-act tragedy. It began with an irresponsible expansion of credit to those who could least afford it, metastasized like cancer into systemic threat in the banking system, and culminated in a wholesale bank run on the shadow banking system. A widespread collapse in trust then sent the global economy over the cliff, as the world tumbled into the worst recession since the 1930s. Could something like this happen again? Given how humans tend to downplay or ignore financial history, we must sadly conclude that it not only could, but most probably will happen again at some point. Let's start our account of the 2008-9 global financial crisis, or GFC, with its context. The U.S. economy in the early 2000s. The GFC did not begin with a sudden increase in housing demand, but with a massive shift in who was being offered money. Mian and Sufi showed that between 2002 and 2005, mortgage credit grew most rapidly in areas where income was actually declining. This was the opposite of what economists claimed, that credit follows income growth. This shift in low-quality credit, driven by the securitization of subprime loans, was strong enough to drive house prices up. Why did mortgage lenders such as Countrywide and many others recklessly lend money to people they knew would default? Simple. These mortgage originators operated as a loan factory. Instead of holding mortgages on its books to collect interest over many years, which had been the traditional banking model, it focused on originate to distribute. They securitized and then sold their bundled mortgages to investors around the world. In short, they shifted the risk to someone else. From 2003 to 2006, U.S. house prices boomed by 50%. Robert Shiller looked at over 100 years of data. He found that inflation-adjusted home prices had been remarkably flat. By 2004, Shiller's index showed prices skyrocketing far beyond anything ever seen, with no increase in building costs or population growth to justify. He called the housing bubble. But orthodox folks such as Fed Chair Ben Bernanke argued that rising home prices were primarily driven by strong fundamentals rather than a bubble. Securitization required that mortgage originators held mortgages in their books for the weeks required to package and then sell. Would they be able to keep dancing if house prices stopped rising? Such originators were not banks and did not take deposits. They borrowed from Wall Street investment banks for a few weeks. But as mortgage defaults rose in late 2006, Wall Street banks suddenly refused to lend the originator the money to fund new mortgages. And the house of cards came tumbling down. The first high-profile mortgage originator to go bust was Own It Mortgage Solutions in December 2006. This was the canary in the coal mine for the GFC. The next mortgage originator to go bust was New Century Financial in April 27. Between 2007 and 2008, at least 169 independent mortgage companies blew up. This table shows the most significant failures and forced acquisitions. Would these bankruptcies stay within mortgage originators, or would the carnage reach the banks that had lent to them? A localized housing dip should not have collapsed the global economy according to orthodox economists. But it did. Marcus Brunnermeyer explains the amplification mechanisms that turned a $500 billion subprime loss into a multi-trillion-dollar global disaster, the liquidity spiral. As asset prices fell, leveraged financial institutions faced margin calls, forcing them to sell assets to raise cash. These fire sales pushed prices down further, leading to even more margin calls. This feedback loop drained the market of liquidity, making it impossible for even healthy firms to find the cash needed to operate day to day. The result? From 2007 to 2009, at least 160 banks failed in the U.S. alone. Because U.S. subprime had been sold overseas, and these assets were close to worthless, some banks in Europe blew up too. The most notable implosions are seen in this table. Lehman was the largest bankruptcy in U.S. history. While the panic of 1907 featured long lines of people outside banks, the 2008 GFC featured a digital run on shadow banks. What are shadow banks? These are financial institutions that lend money without being regulated like banks. A shadow bank like Lehman got leveraged over 30-to-1 without guardrails. Dick Fuld, Lehman's CEO, famously believed that the US government would not allow Lehman to fail. He saw no problem with privatizing his profits whilst socializing his losses. What was the difference between the Knickerbocker Trust in 1907 and Lehman in 2008? Not much, according to Tolman and Moen, as seen here before. Gary Gorton explains that the 2008 GFC centered on the repo market, where banks use collateral like mortgage-backed securities to secure short-term loans. As the quality of that collateral became suspect, lenders demanded more collateral. This caused a massive systemic withdrawal of credit from the financial system. How did a mortgage crisis in U.S. suburbs become a global calamity? The complexity and opacity of financial engineering meant that no one knew exactly where the toxic subprime assets were hidden. This uncertainty led to a complete breakdown in trust. Banks stopped lending to one another because they couldn't verify their peers' solvency. What were the ratings agencies doing? Sadly, the three major credit ratings agencies, Moody's, Standard & Poor's and Fitch, actually enabled the GFC. Their role should have been as independent gatekeepers of risk. Instead, they provided a seal of approval to billions of dollars in toxic subprime debt. Without their AA ratings, the securitization machine would have ground to a halt because institutional investors like pension funds are legally prohibited from buying anything with a lower rating. But because the ratings agencies were paid by the investment banks that created the securities, they saw no problem in slapping AA onto any junk. Every link in the chain seemed to embrace dishonesty. Subprime borrowers lied on their mortgage applications. Mortgage originators encouraged borrowers to lie. Investment banks securitized junk that they knew would implode, and paid ratings agencies to slap AAA on that. Academics took money too. Fred Mishkin received $124,000 in 26 to tout Icelandic banks. These banks then blew up. But do not take our word for it. Watch The Inside Job and The Big Short if you still have not. Thomas Willett shows that three defective mental models contributed to the GFC. First, the fantasy that house prices always rise. Second, the illusion that modern financial engineering enabled risk to be dealt with. Third, the dream that competition in the financial sector is sufficient to make it self-regulate. This old dream of self-regulation keeps reappearing, despite plenty of historical evidence against it. Ideology and economic interest would like us to ignore events such as 1907 or 2008. The U.S. stock market crashed 55% by 2009. 8 million Americans lost their homes to foreclosure. At peak crisis, 25% of all U.S. homes were underwater. U.S. unemployment doubled to 10%. U.S. households lost $19 trillion in wealth. Globally, the International Labor Organization estimated that 200 million people lost their jobs. Global GDP fell by 5% in 2009. In Europe, the sovereign debt crisis followed in Portugal, Italy, Ireland, Greece, and Spain. These were not happy days. The centerpiece of the American bailout was the Troubled Asset Relief Program, signed by President Bush Jr. in October 2008. While authorized for $700 billion, the actual amount disbursed was $426 billion. Beneficiaries included Citigroup, Bank of America, AIG, GM, and Chrysler. TARP represented 5% of the U.S. GDP. It was large but not the largest bailout in financial history. For this, we must go all the way back to ancient Rome, as seen earlier here. Our verified sources are here. Write to us in the comments section if your interpretation is different, or if you'd like to suggest other sources. If you have been watching us for some time, we must apologize for sounding like a broken record. History rhymes. In financial markets, events usually reappear a few decades after the previous blow-up, at which point everyone who lost money are either retired or dead. The story behind the 2008 GFC was the same behind the panic of 1907. Unsupervised shadow banks taking risks that regulated banks would not dare touch. Could have happened in the future again. A shadow banking system still exists today, and it's actually larger and more complex than ever. Look around. Can you identify shadow banks? Some examples include private credit, fintech lenders, and structured finance vehicles. Is it possible that they take more risk because they are less regulated? Would you be surprised if any of these blew up in a future financial crisis? Thank you for watching. If you'd like to see more financial history from verified sources, subscribe to our channel and join our community of individual investors who strive to learn from the misfortunes of others to avoid similar fates.